Hey guys, how's it going? It's Andy from Magoo Investing. Welcome back. Hopefully everyone had a great holidays or at least some good time off. And today we're going to be back talking about the stock market. In today's episode of Robinhood Top Stocks, we're going to be talking about Best Buy, ticker symbol BBY. And so the reason I'm talking about Best Buy today is I've kind of been hearing stuff about how well it's been doing this year, but then recently for Christmas, my family bought some stuff through Best Buy, and my dad was talking about how good of an experience he had where he purchased it online to pick up in the stores, and it was just there waiting for him when he showed up, and it was great. So today I thought I'd break down what I see in the company because it has a really interesting history of it taking advantage of the tech boom in the early 2000s and how they fell off in the early 2010s and how they've recovered and have established them as being one of the top electronic retailers out there right now. Before we get started, I got to say that I'm not a licensed financial advisor, and I highly recommend talking to a professional, someone that can find you the best places to put your money going forward. In addition, I really appreciate if you hit that like and subscribe button, as it would help my channel out a lot. And so I talked about how Best Buy has kind of had this crazy roller coaster of a stock experience since the early 2000s. And so hearing that it's gone from $55 in 2006 to bottoming out at $11 at the end of 2012, 2013, and now it's currently sitting at $87. I think that it doesn't do it justice on how crazy of price movement the stock has had in the past. It went from being one of the most popular electronic retailers to thinking they might go out of business to back on top at this point. So I think it's really interesting to talk about how a company has struggled in the past couple years and has kind of redefined their company. And so a lot of times recently in past videos, I talked about Macy's and GameStop are the ones that I think of. I've talked about how I don't think that they're a great opportunity right now, but with the ability for the company to restructure and fix the problems that they've had, I think it's a great opportunity. And so Best Buy is a great example of how people thought they might go out of business and they restructured their company, they brought in a new CEO, and they changed the dynamic of how the company works, and they've done very well since then. And so one of the big problems that Best Buy had in the early 2010s, it's actually two main things. So they expanded to countries like China, Canada, and the UK with not a lot of success. And so in end of 2013, 2014, they ended up closing a lot of those stores. And when a stock starts closing stores, it's not a really good look for the company, and the stock fell. In addition, that's when Amazon was kind of becoming the giant that it is, and they were getting really outcompeted. I talked about in the FedEx video, which if you missed that, I'll throw it up right now. I kind of talked about how going up against Amazon, you normally lose. Amazon is known as being a company killer. They kind of come in, take all of the market share, and then kind of run you out of business. And so in that video, I talked about how Best Buy kind of came in, saw the problems that were happening. One of the most common things is people would come into Best Buy to try out a product and then buy it on Amazon. And so instead of just thinking, oh man, we're screwed, like Amazon's got the better service, the better infrastructure, we're toast. No, they came in, brought in a new CEO that changed how the company works. A lot of focus on customer interaction, which Amazon does not have. And then they also implemented price match, which is a huge boost to the company. And while it doesn't really help with sales or making an additional profit, it makes it so that instead of people coming to the store, trying out the products, and then buying it off Amazon, why not just buy it off of Best Buy in person if you've already tried it? And instead of having to wait 1 to 2 days for shipping, you can just pick it up right now. And so since the company implemented that, the earnings per share has increased, because even though they're not making as much margin on every item out there, they're having more sales overall, which has really helped the company revitalize itself. And so since 2014, the stock has steadily climbed. It had a little dip when the market fell overall last year, but you can't really blame them for that. And now it's currently sitting at $87 and up 65% year to date. Obviously, there's been a lot of bright spots in the market this year, but I think Best Buy being up 65%, going to all-time highs, is just a great example of how a company can figure out what's going wrong, fix it, and then start to thrive after. So with that being said, let's start talking about the fundamentals, because there's a lot to break down. Because when you have all this talk that maybe the company's going to go bankrupt, you kind of have that thought in your mind that maybe that'll happen again if they kind of get complacent. But from what I've seen, I think everything looks really solid fundamentals-wise. One of the articles that I saw was that in 2014, one of the earnings that they had was their 10th straight decline in earnings. And since then, the earnings have all looked really good. And so it appears like they hit their bottom, and then they implemented the changes into the company, and the earnings have reflected this change. So I think that's really solid to see. 2014 is also when they closed a lot of stores, and so that kind of makes sense why the debt would go up, because you're probably not selling at full price. You're probably not doing a great job getting all your money back. So the debt was increasing in the middle of the 2010s, like 2014, 2015, and since then it's kind of steadied. And there was a 5% increase in debt, which I'm actually okay with. Compared to, I'm pretty sure the year before that was 25% increase, so I think that's totally manageable. And so while they're not expanding their stores, I looked at their store count over the years and it's steadily gone down, but I think that's actually a really good thing. And so I think that the company expanded too fast and kind of ran too hot based off of the tech boom. And then I think they've kind of toned it back and they figured out what they're really good at. And so while you don't have any increases in the number of stores out there, their online sales have increased steadily since then. You don't really need to be increasing the number of stores if your online sales have been steadily increasing over the years. You don't have to buy the retail space, you don't have to pay as many employees, and I think it's a really solid point that they've figured out how to take advantage of the online space, which has been dominated by Amazon, and which is where they lost a lot of their money to, because Amazon was doing the online stuff really well, and they were taking the physical sales from Best Buy as well. So Price Match comes in, they increase their online presence, and they've really succeeded with that. Also got to mention that they have a dividend of around 2.2 to 2.3%, which is not something amazing. It's not going to be on a list of top dividend stocks for sure, but when you're up 65% year to date and a little additional dividend, I think that's a great opportunity to be in. You know, when you're having a growth stock like this and business has been booming, I would happily take an extra 2% on top of the 65% year to date. So just something to talk about. Recently, I've been focusing more on PE ratio, which is the price over earnings ratio. And it kind of talks about how overvalued a company may be. And so when we talked about Salesforce a couple days ago, if you missed that, I'll throw that up there as well. They had a PE ratio of about 150. And so looking at Best Buy, which is another tech company, obviously they're more retail, but they focus on tech, they're sitting at around 20. And it has been steady for the past couple years. And what that really means is that as the stock price has really increased, which we showed from the charts, the earnings have increased as well. So they're kind of pacing each other. And so seeing a steady PE ratio, I think is more attractive than seeing a really low PE ratio, because it means that as their stock price has gone up, their earnings have gone up. And it's kind of explained this boost in price. And so when you see something with 150 for a PE ratio, you kind of have to think, is it overvalued? But when the stock has been steady at 20, I think it's a really good sign. And the final fundamental thing I want to talk about is all of the expectations for earnings that I've seen have been increased for the upcoming years. And so you have year over year increase, and that just seems like more positive news for Best Buy going forward. When you're kind of looking at the market overall, you kind of have to see what people are thinking about the company. And when you're seeing that most of the people are giving it the thumbs up for the upcoming future, I think that's great news. And so everything I've seen is solid about the fundamentals, the history of the company, their change. And let's head on over the charts and we'll talk about what I see for the technical analysis, and then we'll finish it off and see what the analysts have to say about Best Buy. Now let's go take a look at the charts for Best Buy, ticker symbol BBY. So here we are on Robinhood. As you can see, my portfolio is up around 1% today, based off of TQQ and Bitcoin both having good days, even though for some reason Starbucks is in the red. But let's go see what Best Buy looks like on Robinhood. So ticker symbol BBY. As we go on here, it is absolutely horizontal on the day. I thought it was really interesting based off of everything that I've seen about the company, how well it's done this year. It's at a 59% hold on Robinhood with only 4,600 people owning it. As you can come down here, you see the dividend yield of 2.27%. They have it 34% buy, 59% hold, 7% sell, which I think is really interesting. As you come in here, you can see that they've beat expectations a lot recently. It's positive. This is the holiday season, so it makes a lot of sense for why that is so much higher than everything else. And so they're expecting earnings on February 26th of 2020. So that's just kind of the backstory on that. Now let's go down and look at what the charts look like. Let's close this. So for some reason I have the month chart open. So I like starting on the 180-day 4-hour chart just because that's my favorite swing trading chart. But with this, you can see that not really a lot of great swing trading opportunities. One of the things that I like to point out here is, actually let's go to the longer chart. And so I talked about this a lot on the channel, that when you're trying to bust through a 52-week high or just an all-time high, sometimes it takes a little bit extra to get through that resistance. And so as you can see, as you come in here, here was the earnings, and that was enough for it to gap up, push up, and then come back, retest it, push up. So that looks great to me. That's one of my favorite things to see, is if earnings push it up, and then they come back, retest that resistance, which is now support, to see if it holds, and it pushes above that. So that gets the thumbs up from me on that one. I've charted out some other levels on here that I think are good levels. I don't think they'll be hitting this anytime soon, but I like to chart these out just in case. Just in case the market goes south, I can set an alert for down here. you never know when you're just going to get an alert about some beautiful looking stock that you've kind of forgotten about recently, and then you get a great buying opportunity. And so this makes it so you don't have to check all these stocks every day. You can just set these alerts, let them sit for a while, and go do your own thing and take positions in other stocks. So I'm going to show the 10-year 1 month just to kind of show the history that the stock has had. As you can see, here are the lows from 2012. It comes up here. Here's where you have the bad news about they start closing stores, earnings have been declining, and then the stock has kind of been steadily pushing up. Here's the fall of last winter, which, can't really blame them for that. The market overall had a tough time, but it's just really interesting, in my opinion, just kind of look at how incredible this recovery has been, where it was at $47 in 2010, comes all the way down to $11, starts recovering, gaps back down in 2014, and then has been just pushing up. And it's a very, very great story. We'll have to see what the analysts have to say. I like going to CNN first. So as you can see, 66% year to date, but they're kind of bearish on it overall, which I was really surprised about. There's not a lot on here that I see that would, or on the charts and the fundamentals, that would tell me that a low of 30% is reasonable. The only thing I can think is maybe the market maybe thinks that the stock went up too fast and it's going to come down. And so if that's the case, that's why it's really important to set these alerts, because if it comes down to the $61 mark right here, you know what? I've already charted that, so I will know if it reaches that level. I am a little more bullish overall. I think 15% would be a great year for them after an incredible year right here. I don't see the 30% down happening realistically unless the whole market goes kaput, but that's what they think, and I like getting all the information I possibly can. So Yahoo Finance, which is notoriously bearish, has it as a hold near fair value, which I think is really interesting, because most of the stocks we look at on here, they have it as overvalued. So they have it near fair value up in the short, medium, and long term. So surprisingly, they are bullish, even though their 1 year price target is just slightly below where it is currently. So the earnings look great. I think the PE ratio looks great. I think the charts look fantastic, and I think Best Buy as a whole is a great looking stock. Overall, Best Buy looks like a fantastic company. I love their recovery from their 2014 lows. They've just a fantastic story out there. Obviously, it's at a 52-week high, which is not my favorite, but based off of all the fundamentals that I've seen, I think this is a great long-term investment. You're probably not going to be making 65% this year. That's just my guess. But I think for the long term, they have cemented themselves as being one of the top electronic retailers and have showed that you can fight back against Amazon and actually thrive as long as you can find your own niche. So I think that's a great story for a bunch of other companies that are getting outcompeted by Amazon currently. FedEx is the one that I'm thinking about right now. But overall, I think Best Buy is great. I love their story, and I think their stock is also great. So let me know what you think about Best Buy, ticker symbol BBY, in the comment section down below, and let me know what stocks you're watching towards the end of the year and going into 2020. Thanks for watching this episode of Robinhood Top Stocks. If you liked it or if you learned something, I really appreciate it if you hit that like and subscribe button, as it would help my channel out a lot. Thanks for watching. I'll see you on the next video.